Okay, we're going to talk more about the detail of the business of the IPOs. We're joined from Chicago by Joseph Schuster, founder of IPOX. Schuster, welcome to the show. Okay, for our international audience, for a lot of them, they don't know, they know what an IPO is, but they don't know how to actually buy into the IPO. So in a very brief explanation, how does one buy into the IPO, whether it's Alibaba or any other IPO for that matter, here in the United States?
Well, first of all, it's about this initial pricing time frame. So you have an account with an underwriter which is associated with the deal, like a Merrill Lynch, like a Goldman Sachs or a Morgan Stanley. These companies have a certain allocation from the deal as a whole, and then you would basically subscribe to the respective deal. And on the evening or on the morning when the deal actually starts to trade, your broker will call you that you received a certain number of shares. That's
so first of all, it sounds like you have to have an account. You have to have an account
Correct.
with a bank. Then you have to ask the bank that you have the account with that you want the candy. Let's say the IPO is candy. You want a certain amount of candy.
Correct.
And then you have to hope that the bank will give you the candy. Am I right? So there's no guarantee you're going to get anything.
No guarantee you get anything. However, as it turns out, really for the retail investor, it's not about really getting into the deal at the onset. It's about really how to diversify and how to hold the respective company in the long run. This is really the most important part about an IPO or spin-off, for the matter of fact, is how to treat it in the aftermarket once it's trading. This very initial kind of pricing period is really, very professional, very kind of reserved for a certain type of investors. It's really for you and I, it's about the importance is how to treat the company in the aftermarket as part of your portfolio.
I was reading somewhere Jack Ma's and SoftBank and also Yahoo, they're selling a big stake. Now, all those shares are going to go to either institutions or rich people. I mean, I think that's a fair statement. I mean, these are not people off the streets. These are very, very wealthy individuals who have these very big accounts who the banks are going to give them shares. For you and I, if we have to go and buy it after it goes public, isn't the price going to be higher, assuming the IPO is doing good when it first opens up, right?
Well, I mean, the conventional belief is obviously we have to buy at a certain premium to the offering price. And, the premium is much higher for smaller and mid-cap IPOs than for larger IPOs. So we may have to buy 5 or 8% higher. But really, over the long run, let's take the next 4 to 5 years when we have this company in the portfolio, this 4 to 5% is not really significant in actually making us money or not. It's really about how we hold the stock as a part of the portfolio in the long run.
I agree with you. Over the long run, it may or may not be significant. For somebody watching the show, they're going to say, well, hold on a second. If these big companies are getting the stock at a lesser price than what I myself would go in when I buy it after it goes public, why not make it the other way around? Why not give it to me at the cheaper price and I'll sell it to the companies at a higher price? I mean, after all, they're the big long-term holders of the stock if they feel so strongly about it. If it's not a big deal, why don't they pay the higher price for it?
We all assume here that initial pop will be positive with an Alibaba, and that obviously Alibaba will leave money on the table, and this money goes to sovereign wealth funds and hedge funds and so forth. There's no guarantee that Alibaba will leave a lot of money on the table. As it was with Facebook, the deal actually traded unchanged on the first day. As it was with Synchrony Financial recently, the deal was flat on the first day because these are very, very large deals. So on average, getting into the IPO for institutions is also a compensation for risk and this initial returns this institution actually get.
Okay.
So for the retail, again, our focus is diversification and how you hold it in the long run. That's the key. It's not short-term trading.
Okay. Let's just talk about IPOs in general. If I'm a foreign citizen and I live, whether I'm living in Europe or Asia, and I want to participate in IPOs, for example, in this case, Alibaba, but I don't have an account set up here because, well, I don't live here in this particular case. How do I participate in the IPO, or do I or maybe I can't?
Well, there are certain funds out there which obviously participate in IPOs, such as large mutual funds like the Fidelity funds and so forth. There are specialized IPO funds available in the United States, which invest in IPOs and spin-offs only, such as First Trust US IPO fund, very successful fund, $500 million fund run by myself. We don't buy at the offering. We find the key is really how you treat IPOs in the aftermarket, and you can do it very, very successfully, as we have shown it. And Alibaba will be tracked in an upcoming ETF, which is the First Trust International IPO fund. Ticker is FPXI, and that's where investors can get access to that fund.
Very quickly, I want to ask you this, because this is one of the criticisms about the system, is that the big, wealthy funds, whatever they are, get the IPOs, they sell it, they make the money, the little guys come in later, they ended up holding the stock goes down, and if it does go down, they're stuck with it. Is that fair?
That's not entirely correct, I would say. Again, most importantly for the retail investor, stay away from picking IPOs, look at IPOs from an asset class, buy all the IPOs within a diversified context in the aftermarket. You can be very, very successful by investing in that space. Very good asset allocation benefits from it.
So I guess it's much more complicated than just buying and selling something. You have to do some research.